Should you buy a home in 2026? This is the central question facing many Americans right now. The answer is not simple. It is a decision that involves your money, your future, and your peace of mind. For years, the housing market has been a roller coaster. Prices have climbed. Rates have changed. Now, as we stand here in late 2025 and look toward the new year, uncertainty remains a dominant theme. Making the right choice requires looking at the facts, understanding the risks, and knowing your own financial situation inside and out. Let's start with the numbers. As we look toward 2026, mortgage rates are a major part of the conversation. They are higher now than they were a few years ago. This is not an accident. The Federal Reserve raised its key interest rate multiple times to cool down a hot economy and fight inflation. When the Fed makes borrowing more expensive for banks, banks make borrowing more expensive for you. This is why mortgage rates climbed. This increase in rates has a direct and significant impact on how much house you can afford. It changes your potential monthly payment. Right now, in late 2025, a typical 30-year fixed-rate mortgage is hovering in the high 6 to low 7% range. For example, a rate of 6.8% is not uncommon for a borrower with a good credit profile. This number is not set in stone for everyone. Your personal rate will depend on several key factors. Everyone is watching the Federal Reserve. Its decisions on interest rates send ripples across the entire economy, the housing market included. The Fed doesn't directly set advertised mortgage rates. It controls a short-term lending rate, but its actions and, just as importantly, its words move long-term bond yields, which mortgage rates tend to follow. That's why a potential Fed rate cut in 2026 matters to homebuyers. So, what could happen? Path 1. The Fed sees inflation under control. It could begin slowly cutting its benchmark rate. Mortgage rates would likely drift downward. 1/4 point cut won't shock markets overnight. Despite the high rates and economic uncertainty, there are compelling reasons why buying a home in 2026 could be a smart move. The first and most straightforward advantage is that you stop paying rent. Every rent check you write goes to your landlord, building their wealth. When you own a home, your monthly mortgage payment is an investment in your own asset. A portion of each payment goes toward the principal, which builds your equity. You are essentially paying yourself, slowly turning housing costs into personal net worth over the long term. Another significant pro is locking in the price of the home. History shows real estate tends to appreciate over the long run. If you buy in 2026 and prices trend up, you benefit from that growth. The current market also offers a potential advantage: less competition. With fewer buyers, you have more leverage and more time to decide. Sellers may be more willing to negotiate on price or contribute to your closing costs or agree to make repairs before the sale. This calmer market can make buying less stressful and potentially more affordable. Of course, there is another side to this coin. Waiting to buy a home in 2026 also has its own set of strong arguments, primarily centered on financial risk and potential future opportunities. The most immediate con of buying now is the high cost of borrowing. Today's mortgage rates, while lower than their recent peaks, are still historically elevated. A higher interest rate means a significantly larger portion of your monthly payment goes toward interest, especially in the early years of the loan. This means you build equity more slowly and pay tens of thousands of dollars more over the life of the loan. The second major risk is the potential for home prices to fall. Or a full-blown recession could change that. You could find yourself underwater, meaning you owe more on your mortgage than the home is worth. The word recession makes many people nervous, and for good reason. An economic downturn often means job losses and financial uncertainty. However, buying a home during a recession is not automatically a bad idea. It can present unique opportunities and significant risks. Housing demand typically cools off. Fewer people are able or willing to buy. That shift can lead to a drop in home values. Sellers become more motivated. That gives you more negotiating power. Frenzied post-pandemic bidding wars evaporate. Instead of making a snap decision or waiving contingencies, you can take your time. But the risks are real. The biggest danger is job security. To make this more concrete, let's walk through two simple scenarios. These are not predictions, but illustrations of how things could play out. We will use the same starting point for both. You are buying a $350,000 home with a 20% down payment, which is $70,000. This means your loan amount is $280,000. Let's assume you lock in a 30-year fixed-rate mortgage at 6.5%. your monthly payment for principal and interest would be approximately $1,770. This does not include taxes, insurance, maintenance, but we will focus on the loan itself for clarity. Scenario A is the best case outcome. You buy the home in early 2026. By 2027, mortgage rates have fallen to 5.0%. You decide to refinance your $280,000 loan. Your new monthly principal and interest payment would be about $1,503, a savings of $267 every single month. Navigating the decision to buy a home can feel overwhelming. To simplify things, rely on a few time-tested rules of thumb. These aren't rigid laws, just guiding principles to gauge your readiness and reduce risk. First and foremost, protect yourself with an emergency fund. In uncertain times, this is non-negotiable. Aim for at least 6 months of essential living expenses saved in cash. If your job feels less secure, or you are the sole earner, push that to 9 months, or even 12 months. Second, focus on the down payment. Some loans allow as little as 3% down. Aim for the traditional 20%. 20% helps you avoid private mortgage insurance. It lowers your loan-to-value ratio, which can help you qualify for a better interest rate, and it gives you an equity cushion from day one. That protects you against modest declines in home prices, and reduces the risk of becoming underwater on your loan. So, we return to the original question: should you buy a home in 2026? As we have seen, there is no universal yes or no. The right answer is deeply personal. It depends less on what the market does next and more on where you stand today. Stable income, a robust emergency fund, a significant down payment saved. If you have those, buying in 2026 could be a fantastic long-term decision, potential to refinance to a lower rate later. If instead your job feels uncertain, your savings are thin, or the monthly payment would stretch your budget, waiting is the prudent choice. Use the time to your advantage, pay down debt, boost your credit score, save more for a down payment. Your next steps should be clear and methodical.